So I want to welcome everyone to the uh, tutorial, I think number 4 for credit risk and credit as an asset class. Thank you for coming. Today is the 24th of April, 2018. There will be a few more people coming through, but I want to start early, otherwise there's no point you coming on time. Now, what I actually want to do today is to go through a number of concepts that people often ask me about, and these include things to do with even just simple fixed income. I want to say something more about interest rate swaps, especially cross-currency swaps and credit default swaps. And I'm going to try and tie everything together and talk about credit default swaps, credit-linked notes, and asset swaps, and just simply being long on a leverage basis. I think when we do that, the material that's been presented to you in lectures are going to make a lot more sense. Now, some of the things that I'm going to say to you, I know will be very useful to you when you go out there. It doesn't really matter what you do, whether you want to be a fund manager or whether you want to be a fixed income, whether you're on the buy side or the sell side, whether you are running, some corporate balance sheet as a treasurer, you need to know these things. And what's more, first of all, you won't learn them in textbooks. And second, and I know this from experience, you might be a little bit too embarrassed to ask someone, and then they say, "What? You don't know that?" So I'm just trying to help here in the remaining time that we have, okay? And so I think it will be useful for you. I'm just going to start with some macro remarks. And you may remember that last time we met, I briefly spoke about, under what circumstance normally do you see the currency of a country start getting stronger versus other countries, and also versus other things such as oil or maybe gold. Okay, and I mentioned that this is when the supply of that currency may be going down, and the best evidence of that obviously is the tightening of monetary policy. And I also mentioned that if the demand is going up, okay, so people need to have, in the case of the U.S., they need to have dollars because maybe they want to rebuild their infrastructure, and at the same time they're cutting taxes. So people are kind of getting quite alarmed, starting to, that they're going to run a fiscal deficit. Now, that's not our problem. So I'm just we're just here to interpret markets. But my conclusion was that because we seem to be at this point in the economic cycle, with interest rates going down and going up, and bond yields also are going up. Did you notice there was a big story this week in the US bond market? What was that? The 10-year the 10-year government bond yield, or US Treasury, 10-year US Treasury note, actually hit 3%. Now, if you ask me, I mean, honestly, I think it's all much drama over nothing, because, well, it was getting close to 3% anyway. So look at the 10-year column, the column, third one from the right-hand side. So it was, well, I guess at the start of the month, so that would be April the 2nd, it opened at 273, 279, 283, and so on. And then these are closing markets. So on the April the 24th was the first time when it actually closed at 3%. Then it closed above that the day after. Now it's gone down a little. Now, my view is that, okay, 3%. Wow, we haven't seen that since 2014. But in the end, it's just a number, right? What is the difference between 3 and 2.99 or 3.01? Who cares, okay? So don't take these things too seriously. But if it keeps going up, okay, that is a problem. Anyway, my point is, because interest rates seem to be heading higher, the point I was trying to make last week was that, when you have rising interest rates, the currency tends to get stronger, and this seems to be finally happening. I think I introduced to you guys, just hold on a second. It's my credit file. Here it is. So there is this index out there. Well, let me ask you another way. If you were writing a letter to your clients, for example, and you want to let them know that the recent trend of the US dollar, whether it's become stronger or weaker, what is the best indicator? Well, it's not the best actually, but what is a common indicator that markets frequently would use? Do you know what that is? They talk about that a lot actually in the financial press, in Bloomberg, in Reuters, on TV, and so on. Do you know what an index is? Any idea? Anyone? It's called a DXY. Okay, now you go to Bloomberg, you type DXY index, and I guarantee that something will pop up. Now, what is the DXY index? You can Google it, and in fact, I'll tell you why I don't think it's actually very good, but this is what people use, and you hear people referring to it all the time. Now, what is dollar index and how is it calculated? It's not even correct grammatically. So this index is calculated. Now they're talking about the DXY, okay, or USDX, DXY. But anyway, the DXY index has a basket of currencies in there. So it would be as if you're carrying a basket and in that basket are a number of currencies. The problem I have is the currencies that are in it. Look at it, okay? The euro, the yen, fine, Canadian dollar, pound, Swedish krona. What's that doing there? And Swiss franc. Okay, so it's actually, it is hopelessly out of date, is my view. And if, in fact, if you go here, all right, here you go. So here is the composition. So it practically is about the euro. It's 58%. And then there's Japanese yen, pound, Canadian dollar, Swedish krona, and Swiss franc. Where is the renminbi to start with? Okay, I don't now. It's because this has been around for so long. People use that. It's been around since the 1970s. Okay, started in 1973, and the index at the time was 100. What is the value now? Well, as of yesterday, 91.3. I don't think these actually take interest rates into account. So it practically hasn't done anything for 40 years, which may be a good thing. It just means that the US dollar is stable. If you're an optimist, you can look at it that way. Okay, so it's lost around 8.5% over a 40. How long ago is it? 73? 45 years. Okay, but my point to you is this. So I kept saying that the US dollar has been strengthening. Well, has it? Well, this is a one-day chart, so it's not really very meaningful. So you can look at a 1 month. Okay, now this is the index value. So the higher value you see, that means the stronger is the US dollar. Okay. So on a 1 month basis, it does seem to be sort of heading up. But with these things, you know, anything which is macro, and you're talking about trends, you do have to look at least like a 3 month or maybe a 6 month. Okay, now there was a time 6 months ago. What were you doing 6 months ago? Well, you were here, weren't you? Okay, where it came sort of tumbling down. So if you look at the last part on the right hand side, at least it now seems to be rising. Okay, that's what we're trying to say here. But like I said, I don't really take this index very seriously. The two good things about it is, number one, it is quite well known. It's been around for a long time, so everybody knows what's inside, number one. Number two, number two, you actually can trade on it. There are futures contracts. So if you have a view on the US dollar, if you think it's going to get stronger, but I don't know why you wouldn't just trade the euro. But if you think it's going to get stronger against this basket of currencies, there is a futures contract on this that you can trade. Okay. All right. So just a bit of macro background for you. Okay. What else can I say about? Okay, so we have had. Well, I can say a little bit more if you're interested. If you look at the S&P 500 for the last week, this is 5 days. So this is just the last week. So what has happened is that the market sort of went nowhere in particular, and then on Wednesday, I think it went south, and there was, you know, a substantial sell-off. So from 2,680 to 2,660, that is 60. That is 60 index points, which is more than 2%. But then it came back up. So over a week, it's practically not done anything. Now, I think the market is kind of quite worried, or at least in some sector, they are worried about rising bond yields, and they are worried about inflation. Okay. Now, I guess my question to you, and you won't learn this from textbooks, okay, is, so are we saying that when interest rates are rising, stock prices are falling? Is that the kind of relationship we look? Because that's what seems to be happening, at least for the last few weeks. Okay, are we saying that is this like a textbook formula? Oh, rates are rising, so stocks are falling. Is it really that simple? Well, hello. My observation is that actually this is not always the case. Okay. Now, what does it mean when rates are rising? So that means if you look at bond prices, okay, so bond prices are falling, and stock prices are falling too as a result. Okay. I can think of alternate scenarios when bond prices are falling, but stock price is rising. And I can think of alternate scenarios when the bond price is rising and stock prices are falling. Okay, so I can think of, you can even get scenarios when the bond price is rising and the stock price is rising. Now, we can focus on this one first, okay? Now, when the bond price is, now let's talk about the one in the middle first, okay? So this is what seems to be happening recently, okay? So I'm just trying to give you a bit of advice, at least, especially those of you who are thinking to take up an analyst career, then you need to think creatively of things like that. Okay. Now, under what circumstance can you get bond price falling, but stock price is rising? In other words, interest rates are going up. So bond prices are falling, but stock prices are rising. Well, it's very simple. And you kind of go back to basics, absolute basics. If you look at the price of a stock being do you remember our old friend? The good old dividend discount model, okay? Now, the point is, why is it that when interest rates are rising, bond prices have a tendency to fall? Well, that is because this term is in the bottom. So when the discount rate goes up, of course the stock price will fall. But you know what? Sometimes, even if the interest rates are going up, but if the growth rate is also going up, and it may be going up even faster than the rise of interest rates. So end up, this whole term here may well be going down. Now, that is a circumstance when you can have rising stock price even when interest rates are going up. Okay, so I'm just trying to describe to you the kind of scenario, and I have seen this before. Okay, it's another way of saying that when interest rates are going up, okay, that is not always bad news. If interest rates are going up because the growth rate is also increasing, or at least if that's what people in the market are thinking, okay? When the growth rate increases, actually the stock price can keep going for a long time, okay? And I don't know, I think we may actually get that this time, okay? If you believe that a lot of the concerns about inflation is a little bit sort of over-exaggerated. That's what some people say. If you believe that, okay, then we may well get this situation here. If you look at some of the earnings that have come out of the US recently, this week and last week, those numbers are really, they are fantastic. The corporate earnings are very, very strong, okay, and the growth is good. Now, just so by way of interest, how do you get this situation then? How is it that you can have bond prices going up, which is to say, rates going down, right? And bond prices going up and stock prices are going the other way, because if this is what we have now, it's a kind of correlation. Well, this is the inverse, right? Now, I'll tell you when I saw that happening. Every time there is a crisis like in 2008, when there was a global financial crisis, or 2011, when there was a crisis in the Eurozone, when the euro currency looked like it was about to disintegrate. When there's a crisis like that, or if there's some kind of geopolitical crisis, like US going to war with Russia or whatever, okay, some kind of blow up in the Middle East, 911, okay, that's when the stock market normally will tumble. But the bond market, or at least the government bond market, tends to become what people call a safe haven. Okay? My point to you is simple. Okay? My point to you is this: don't believe there is some kind of fixed correlation between asset classes. Correlation changes from one cycle to the next. Okay, you can't go out there and pick an argument with a trader and say, "Oh, look, bond prices and stock prices are correlating." Well, they are now. Okay, they don't always do that. In fact, here is when they move in opposite direction. Okay, if there's one thing I would love you to learn today, it's probably that. Okay, well, amongst other things. Okay. All right. I spend quite a lot of time talking about this, but it is useful. Now, another thing, some of you were asking me, and this really goes back to the essential. So, how many of you did fixed income here last term? Okay. With Professor, what's his name? Abramov. Okay. Now I haven't said I was a tutor before on fixed income, but that was under another teacher, and I don't know what he's been teaching you. But anyway, there are people here who have not done that course. If you want to be an expert on credit, I mean credit, what is it about? It's about credit risk, and mainly corporate credit risk. It is true, right? But it is about bonds. It's about fixed income, and I have found in my experience that this is the part that some students seem to have a problem understanding the basics. And the basics are very simple. Okay? Problem is either you know it or you don't. Okay? So I'm just going to point them out to you. It won't take very long. Now, when you price a bond, there are three things, or when you trade a bond, that you need to look into. Okay? There is this thing called a total price, sometimes called a dirty price, sometimes called the invoice price. You all know that? Now, this so-called total price is actually a sum of two subcomponents. Two subcomponents. You need to know these things if you're in credit, no matter what you do. Okay? What are these two subcomponents? Do you know? Coupon? Spread? Hello? Very good. That is the AI. It's not artificial intelligence, okay? Accrued interest. And then the what we call the clean price. Did you do fixed income last term? Okay. They told you about that? They didn't? You didn't talk about the price. Yeah. Okay. If you ever go out there and work for a fund manager, on the very first day, on the very first trade, you're going to come across this challenge here, which is you want to trade something, or your boss asks you to trade something. There is a number, there's a price on the screen. It's showing 101.27. What is that? Okay, that's what I'm getting at. Okay, so it's got nothing to do with duration or convexity, all those things. Now, the total price, sometimes called a dirty price or invoice price, is the price that you actually will pay to the seller. Okay. Now, when I say two subcomponents, I guess I didn't ask the question very well, but the two subcomponents are these two. In fact, you can break it down into accrued interest. So that's the amount of interest that has accrued since the last coupon date, but has not been paid to you yet. Okay. And then the other thing is called the clean price, which is just the total price minus the accrued interest. Now, maybe you're wondering, okay, what's the big deal here? Well, there's no big deal. Okay, so first of all, do you know? Okay, first of all, the total is equal to the clean plus the accrued interest. Now, what is accrued interest? Accrued interest is this. So, if you have a bond and it pays an interest of, let's say, 3.65%, I choose this number on purpose, okay, per annum, then the accrued interest of your bond will go up every day by 1 basis point or 1 cent. Okay, it is just a linear record at any moment in time, okay, between one coupon period and the next. Because when you invest in bonds, you do have to earn interest, and earning interest takes time, and accrued interest is an indication of how much interest you have actually earned if you are between two coupon periods. So if there's a coupon payment here, there's a coupon payment here, okay? So although you don't get paid when you have walked all the way from here to here, when you are just right before, okay, so you know how much interest has been accrued. Okay, you know, it's funny in in investment banking, people often use the term accrued interest in another context. Maybe you've heard of that. If you haven't, you will. Okay? So when you work for iBank or when you are in sales and trading in capital markets, so the financial year typically is from January to January, okay? At least as far as your performance is concerned, okay, that the actual fiscal year for the bank may not be, but so your performance is judged from January to December. And then at the end of the year, depending on your performance, then the next year, okay, in the first quarter, they will pay you a bonus. Okay. That's the story. So quite often you hear traders, they will say around September or October, near the end of the year, they will say, if they look at their performance, I've done quite well this year, okay? So they will say to themselves, or they will say to each other, they will say to the friends, oh, I have a bit of accrued interest, which means that they probably will not leave. They will not leave until the bonuses are paid to them. So the concept is kind of similar, okay? But they use the term accrued interest in that sense. Accrued interest is something that belongs to you but hasn't been paid to you yet. Okay? So what is the fuss about the clean price? Well, I'll tell you why it's useful. Okay. Why do we? First of all, when you look into Bloomberg. When you see a whole load of bonds and they are quoting the prices, some will be 101, some will be 99.72. Is that a dirty price or is it a clean price? Do you think? Clean price. Why do you think it's a clean price? It is true. They quote a clean price. Now, I think I can think of at least two reasons they would quote a clean price. Reason number one is with the clean price, if you just add back the accrued interest, which is very, very easy to find out, okay? You knock it out in Excel, it will take you 3 minutes. Okay? If you get the clean price, and you add back the accrued interest, then you know exactly how much will be paid. But that's not really a reason. The reason is that the clean price contains a lot more useful information. Now, I'll give you a very simple demo here. Okay, this is a quick can you read that? Not really. But I need to show you the prices down at the bottom. Okay, now here is a simple bond price calculator where there is a bond which is issued. It doesn't matter. Okay, so issue date is, let's just say September of last year, and this is going to be why is it not a 10-year bond? It's 9.5 years. Okay, never mind. Now the settlement date is just 1 day before. I'm going to change this. So I'm going to put 180. So I'm going to put the settlement date is the issue date. Okay, the issue date is in March. So it's a 10-year bond. I'm going to put the issue date to be 10 I'm going to put the settlement date to be the issue date plus 180 days. All right, and let's say the coupon is 3% and the yield to maturity is 3%. Now, as you would know, or you should know, even if you have not done fixed income, okay, when the coupon and the yield of a bond are the same, then basically the bond price will be at par, okay? The thing is, which bond price? This is the clean price, clean bond price, okay? Notice that this bond was issued in March, the middle of March, and I am pricing it for, let's say, the 11th of September. So that is actually just 4 days before a coupon gets paid. And you can see down there, there is an accrued interest, and the dirty price, I'm sorry, it's a bit small, right? You are adding the two. Yeah, just shrink this. Now, it actually gets more interesting than this. And the reason is when so say the coupon rate is so what you have here is imagine if the market doesn't do anything, okay, which will be extremely unlikely, but which means the yield doesn't change at all, okay, and then now I'm pricing it sort of 1 day after the issue date, and you can see that the accrued interest is very, very little, and then 2 days, and then 3 days. Now the accrued interest is ticking up, but notice that nothing happens to the clean price, and that's not because I type 100. There's a formula in there, okay? The formula is not changing unless the yield to maturity is changing. Okay, so I change it, let's say from 3 to 305. Now the clean price will change. Can you see that? Okay, so what does that mean? That means the clean price is actually a very good indicator of whether the yield is changing or not, whereas the total price, or sometimes called the dirty price, because it is incorporating the change in accrued interest, the whole thing ends up being quite confusing if you look at the change in that price, because the accrued interest gets in the way. Are you with me there? So the clean price is what people look at, okay? Are you all right there? What have a drink? Sometimes when you have oh yeah, of course. Right. And you sign in? Sometimes when your air tracks have an allergy, a good way to try and fix that is to take a quick drink, especially hot drink or warm drink. Okay. Sorry. All right. Okay. So now my point to you is that the clean price is a much better indicator of what is really happening to the bond. So you can see if you change the from 5 to 10, so now it's 10 days after issue, okay, as long as the yield doesn't change, your clean price doesn't change, even though your dirty price at the bottom, it is changing. And when your coupon rate and your yield to maturity are the same, your clean price will remain at par pretty much regardless of what you do to this number here, whether, it doesn't matter where you are pricing it. Now, if you have a big gap, between your coupon and your yield, this still holds, but it's a bit extreme, this one. It's not actually, the clean price will change a little bit, okay? So if I go from 20 to 21, now the coupon rate, I change it to 8%, but the yield is still at 3, okay? And the clean price was 142.72. It's now gone down a little bit, okay, and it will keep doing so. The reason that is happening is that your accrued interest is increasing a lot faster than your discounting, okay? So your clean price, is equal to the total minus the accrued. So with every day that goes by, the accrued will go up and your total will go down because you are discounting for a shorter period. Okay. Now, when these two are perfectly offsetting each other, that is when your yield is equal to the coupon, then your clean price won't change at all. But when you have an extreme gap like that, which will be very unusual, okay, your accrued interest is rising a lot faster. So that's why the clean price will drop. Okay. But anyway, that aside, I'm just trying to explain to you because I said that the clean price doesn't change. You might be wondering, oh, Sam, you said it's not changing, but it is changing a little bit. Okay. But that aside, okay, the clean price gives you actually this is a very extreme example, but let's just say you have 4% coupon, then it's not going to change by much. Okay. So from one day to the next, 108.55, 108.55, it doesn't change. Okay. So your clean price, in other words, is a very good indicator of whether the yield on this bond is changing. If you don't see any change on the clean price or very, very little, so that means not much is happening to the yield. Okay, is everyone okay with that? Yeah, I think you really need to know this to be in credit. And like I said, when you are trading bonds, they are normally quoted on a clean basis. Okay. All right. Now, another thing I just thought I will tell you a bit more about interest rate swaps. Now, some of these notes you should already know, which is what is an interest rate swap. As you know, it's called 掉期. Okay, so you are swapping the long term for the short term, or a long term rate for a series of short term rates. That's what an interest rate swap is. Okay, so you need to know what now LIBOR is the short term rate. So for a 10-year period, for example, if you do it every quarter, then you are swapping one long rate for 40 consecutive short rates. Okay. Now, what I actually want to talk about is that interest rate swaps, actually it can be single currency, but it can also be cross currency. And I guess we mentioned that last time when we spoke about the that Telstra example, okay, because that was a cross currency swap, a cross currency interest rate swap. What's more, it's a cross currency interest rate swap with a difference, because it can be terminated at no cost if there is a credit event happening somewhere else. So that's actually quite unusual. Okay. Now, just want to show you how these things are the market convention for cross-currency swaps. Okay, now let's just say that if you need to understand this, otherwise you would not understand how asset swaps actually work. Okay, so the whole thing will be lost on you. Oh, asset swap, what's going on there? If you have two markets, two completely separated markets, okay. So let's say there is the US dollar swap market. I'm talking about swaps, interest rate swaps for 10-year. Okay, so 10-year US dollar interest rate swap is trading at 228. Now that is driven by, of course, in fact, now it will be higher, I'm sure, because there is this thing called the government bond. Have you heard of the bond swap spread? This is something that people are always looking at. So let's say the 10-year, there's a government bond, and then there's the interest rate swap. The so-called 10-year bond swap spread would be the difference between the 10-year swap rate and the 10-year government bond rate. And like I said, because the 10-year government bond is already 3%, the swap rate is likely to be higher. It's more like 338, but never mind. You know about the bond swap spread? Very good. Now, so in Japan, so this is the yen swap market. And of course, in yen, the interest rates are a lot lower. So it could be that for 10 years, you can swap yen LIBOR into a fixed rate at around 0.73. Okay, let's just say these numbers are valid for what they are. Okay. Now, okay, so I repeat here. So in the first example, if I have a bond and it's a US dollar bond, and I buy that bond and I do some kind of, so what? US dollar fix, that's my bond. Let me make some notes on that. So I'm the investor, and I got this bond which is paying me how much? 228. Wow, that would be a big coincidence. So it's paying me exactly the same rate. So this is the US dollar bond, okay, and it's paying me 228. And I go out there and I do a cross-currency interest rate swap. Now, first of all, what are the steps involved? They are at the beginning, the other party is going to give me some US dollars, and I would need to give them some yen. That's at the start, okay? I need to give them some yen, and then, so this is the swap provider. Typically, that corresponds to the exchange rate. So they might give me 1 million, and I would give them, let's say, 108 million in yen. Okay, and then during the lifetime, I will pay. This is the fixed rate. I will pay them 228 in dollars, and they will pay me in yen. Now, let's say I want a yen fixed rate. What is that yen fixed rate? That is my question. Okay, and in fact, it is very, very simple. So you just look at the two swap markets on their own, and so I'm saying that to start with, a bond that pays 228 will swap into US dollar LIBOR flat. So from here, you can go from here to here. So that is from US dollar fixed to US dollar floating. Okay. Now following that, US dollar LIBOR flat will actually swap into yen LIBOR flat. Now this is what's called do you know what that's called? It's called a cross-currency basis swap. My fear is that, sometimes Ryan, he will mention these terms and he would assume, to be quite fair, that you are already familiar with it. Some of you maybe, some of you may not. Okay, so I want to try and put everyone on the same page. Okay, now a cross-currency basis swap is when you swap from one floating rate to another. So you go from A to B, you go from B to C, and then you can go from C to D. Are you with me? These are all financially or mathematically equivalent. Okay. LIBOR, Japanese yen LIBOR flat will swap into 73 basis points in yen fixed rate. So in other words, if you take a bond like the one that I was trying to show you, and it's a dollar bond, you will get 0.73%. Okay? Is everyone okay with that? Make sure you understand. I really want to try to share with you things that will be useful for you. Okay? Now, I think there is another example. So here, so this time, there is a bond, but it does not pay 2.28, which happens to be the 10-year market swap rate for the U.S. domestic market, if you like, but it actually pays 3.3. Okay. What happens now? Well, it's actually quite simple. So first of all, 3.3 in US dollar will get you LIBOR plus 102. Where does that come from? Because I already told you this is where the 10-year US swap market is. So if you go out there, you are the customer, and there's a bank. As soon as you pay 228, they're going to pay you LIBOR. So if you insist on paying 3.3, they have to pay you LIBOR plus 102 because you have paid 102 above market. Okay? Is everyone okay with that? It really is, it's not even, how to say it, 加減乘除 it's just 加減 okay it's addition and subtraction there's the multiplication and division don't even feature in here okay so and this is called a cross-currency basis swap okay from floating to floating I can tell you a bit more about that but for now just think that this will swap into this and this will swap into this and this will swap into that. It's another way of saying instead of going round counterclockwise, you just go from here to here, don't you? Yeah, that's easier. All right, you can do that too. All right. So, and then you can work out, all right, well, I'm getting 102 basis points extra. So this sort of represented the spread to LIBOR. Okay? If you add that to the yen part, you're going to get 1.75% fixed. Okay, these are not really that hard, but you just need to know how to do it. Okay, everyone is okay? Yeah. So now you know how asset swaps are lined up, how they are priced. Okay. Now credit default swap. Here is just a very quick review because we have talked so much about this already. So I just included some more slides and diagrams to show you how you should know by now how this actually works. Okay. Does anyone have a problem with CDS as a concept? If you do, you let me know later. Okay. So there's a protection buyer, there's a seller. The buyer is paying a regular fee. The protection seller, and they buy protection. Here's the protection. Okay. The key word here is contingent. Contingent means it depends, it's conditional. So you may or may not be paid depending on whether there is a credit event. I have another diagram which explains this a little bit better. So at maturity or before, there's a binary outcome. Either there's no credit event, everybody is happy. Well, I guess the protection buyer is not so happy. They may be happy. Well, why I say this is as follows. Some people, and you have heard this before, some people compare the credit default swap to insurance. Okay, now for a number of reasons, I think it's not entirely appropriate. You know, there is a scenario where you are using it in a similar spirit to an insurance. It is true, but you can also speculate using the CDS. You normally don't speculate with an insurance contract. The reason why I said just now you may be unhappy if there is no credit event, okay, or you may not be unhappy, is if you think about it like insurance. So let's say you have a home and you take out an insurance contract on fire. So it's insured against fire. And then at the end of the year, you don't have a fire. So everything was okay. Are you going to be unhappy? Are you going to say, shit, I paid that premium and now there's no fire? You won't say that, right? So you may or may not be unhappy. But anyway, so it really depends on the circumstance. Okay. Now that is CDS, and if there is a credit event, Either you have cash settlement or you have physical, and we already discussed what that is a couple of tutorials ago. Okay, you guys are okay with that now? Physical versus cash. Okay, that's good. Now, this is not the conclusion. I actually want to show you some slides are not showing up. So I want to show you some more. So this is typically how a credit-linked note and a credit default swap are related to each other. So you have an investor. If the investor wants to buy a note, okay, so they will pay some money, and then the issuer will turn around and they will sell credit protection. So here they are selling, and the protection buyer, so they are the buying party. Okay, and they will pay some regular fee, and then the issuer will take the money and then park it away somewhere else. And let's say that is earning LIBOR. You put the whole thing together. Now you can see that 5 basis points have actually disappeared because there's 105 going in, there's LIBOR going in, but there's only 100 going out. Okay, this is how banks actually earn their money. This is how they make. Otherwise, where's the motivation? Okay, this is how they can earn their fee. So this is the CDS part, and then you just put that together with the funding, and that becomes the credit-linked note. Okay, so I say here the CLN is kind of like the funded alternative, okay, but it's driven by and it's based on the CDS. I can tell you a bit more on asset swaps. One day, some of you may be trading that either as fixed income sales, or you can be a client. So you're buying these things. Now, let's say this is useful to know. There's an investor, okay, and they want to, they are interested in a bond which currently is trading at 102. Okay, so it's not at par, and it pays a coupon, okay, 348. Now, what they can do is this investor can buy this bond at 102, and then the bond is going to pay 348, and then they can turn around and they can actually do an interest rate swap, and they can get LIBOR plus 135. That means, what is the actual swap rate versus LIBOR flat? What is the fixed swap rate? Can you work it out? I've worked it out already. You know what I mean? What's the answer? Very good. Remind me to give you some participation points, okay? 2.13. 2.13 versus LIBOR flat. You can see that because I've kind of given you the answer here. If 348 can get you LIBOR plus 135, what does LIBOR flat get you? Well, you just take away the 135 from 348, okay? So let's say this is the result. Now, here's a problem. So I say here asset swap the wrong way. I mean, this is normally not how people do it. This is not how people do it. You can do it like this. It's not how they do it. How do they do it? How they do it is like this. So typically, when you buy a bond and you do a swap on that, it is usually the same. You are talking to two different desks of the same bank. So if you are going to do the swap with, let's say SG, I've got up there. So you would be talking to the bond desk in SocGen, and you'll be talking to the derivative desk in SocGen. Now, these two desks, they work very closely, and they do talk to, they literally, they sit next to each other, okay? So the fixed income guy will tell the guy on the derivative desk, oh, we have a customer who is interested to buy this bond, and they want to do an asset swap on top of it. The bond guy will say that to the swap guy, okay? And the first question, the swap person, the swap trader will ask, the first question will be, what is the price of your bond? Okay. Now, it's not 100, it's 102. Okay, that's the first question they will ask. And the reason they will ask that question is people normally don't do the asset swap like this. Okay, the way they do it is they do it at par. Okay, that's why asset swaps are sometimes called par asset swaps. But you don't need the word par because people understand that to be at par. Okay, now what does that mean? That means the investor typically will buy the bond at 100. Now, you're going to say, hold on a second, but this bond actually costs 102. How can they buy it at 100? Okay? The reason they will buy it at 100 is that in the swap, they're going to pay you less. Although 348 should swap to 135, they're going to take some money off. They're going to pay you 25 basis points less, or whatever is the discount that they need to price in. They're going to pay you less such that when they pay you less, they will make $2 back from that. Are you with me? Yeah? Now, if you follow me so far, you understand asset swaps. And you go to Bloomberg, you open up an asset swap screen. The command is called ASW. So you go to Bloomberg, you pull up a bond, any bond you want, okay? But better if it's a dollar bond or euro or liquid currency. And then you type ASW and you hit enter. You get the asset swap pricing screen, and you will see something like this. Okay? It's always priced at par. This is what people normally do. And the reason they do that is this investor, you know, it is quite possible that they may have borrowed some money from a bank. And guess what? When people borrow, they don't like to borrow 102. They prefer to borrow 100. Either it's 100 or 100 million, okay? They like round numbers. And then maybe there's a borrowing cost. Let's say LIBOR plus 35. So immediately they can work out everything is on a par basis. This is at par, this is par, and then of course the swap will be based on a round number, which is 100. So they can work out what the profit will be, which is basically they earn 75 basis points. which is the difference between 110 and 35. Okay, so this is how people work in the asset swap market. They try to, well, I guess the word to look for is normalize. Okay, they try to normalize everything back to $100. Okay, is everyone okay? Yeah. Excellent question. Short answer is yes. If you are the investor and you buy this, okay, what have you done? You've done two things. Okay, you have bought this bond. This bond belongs to you. Never mind you buy at par or 102 or 97, whatever, the bond belongs to you. Okay, so you take the risk on that. And then there is a swap over here. Now, this has to go on for the next 10 years. No matter what happens, I don't care if there's World War III. Okay? This swap has to continue, and there will be a mark-to-market. And the obligations of these two parties are that every quarter for the next 10 years, they're going to exchange payments 40 times. And that has to happen even if the bond's gone bankrupt. Okay? And then there, of course, like I said, I must be saying this for 10,000 times. There's mark-to-market exposure on this swap here. And this can make people very nervous, which is why that Telstra extinguisher swap is so interesting, because that is quite unusual. That's a very unusual way of doing things. Okay, you don't see that very often. If you ever go for a job interview and they start asking you, do you want to discuss any interesting transactions? I think that one is a good candidate. It's interesting. And if you talk to someone who is a market professional in fixed income or in interest rate derivatives, they will understand perfectly what you are saying to them. Okay. Have I answered your question, Minjiao? Yeah. Sure. One thing which is worth mentioning is that well, I'll say two more things. Okay? So in the swap market, let's say US dollar 10-year. Just now I said it was like 238 or something like that. Now, what you normally see is there's a kind of mid-market, and then you talk to a bank, you say to them, I want to do a swap. First thing they will ask you is, do you want to pay fixed or do you want to receive fixed? If they are paying fixed, if the bank is paying fixed or the dealer, probably they will pay lower. So that would be the bid side. Okay, so just be aware of these, commercial aspects. But if they were receiving, if you are paying, then probably they will quote you the other side. Okay, that's the first thing to remember. So every time I show you these numbers here, it's just for simplicity. Okay. Now the other thing to mention is, so I said to you that when you have two parties and they are doing a sort of cross-currency basis swap, so you can swap a floating rate in one currency for the floating rate in another currency, and I just put LIBOR flat for dollars versus LIBOR flat for yen. I did that like, around 10 slides ago. Where was it? Here. Okay. I say to you, the third bullet point, dollar LIBOR flat, we swap to yen LIBOR flat. Now, actually, in real life, realistically, this is not exactly true. So there will be some kind of spread. So let's say dollar LIBOR can swap to yen LIBOR minus 10 basis points, something like that. Okay, so there will be a spread to that. So it's not exactly dollar LIBOR flat to yen LIBOR flat. Okay. So maybe if I am the dealer, if I am the trading desk, okay, for me to receive dollar LIBOR, I will pay yen LIBOR minus 12. Okay, but for me to pay dollar LIBOR and receive, now it's the other way around. No, so I want to be paid more. So I might receive yen LIBOR minus 8 or something. Okay. Now this is just to clarify it. This gets you to the professional level. I don't want you to go out there in a few months and you are now in a real financial, banking career. You're looking at a basis swap and you see that, oh, they're not swapping dollar flat to yen flat, but Sam told me they do. What's going on here? Okay, it's because there is a bid offer here. All right. Now one more thing, just to round things up. So here I have put down different ways that you can participate in credit risk, including leverage long. I think that was the very first or maybe the second quiz that Ryan was asking you. So you get a bank to try to borrow on your behalf. You put in some of your own cash, you borrow some more cash, you buy a bond. And what are the components? What is the economic result from the investor's point of view? And what is the nature of your financing? Okay. So I have here at least 4 different ways where you can participate in credit risk. The first two involve leverage. That is why it's in blue. Leverage or unfunded, or at least partially funded and partially unfunded. So CDS can be totally unfunded, whereas leverage long, if you have to put in a bit of your own money, it's like margin trading, so it's partially funded. So credit-linked note, you have to come with the cash, so it's a bit it's safer from a counterparty risk point of view, and then the asset swap. Okay, so you can follow me so far. I think you know a lot about how these things are put together. Just think of it like this. All right. So you want to take some vitamin C, and I recommend you do. Okay, we cannot manufacture our own. Now, how many ways are there? Let's stick with oranges. Okay, so A, you can go out there, you can eat some oranges. Okay. B, you can drink some orange juice. Okay. C, you can take some tablets. Okay, not a good idea, but you can. This is kind of like that, right? So in the end, what is your objective? You want some vitamin C. see, here your objective is you want to take some credit risk. Okay? There are a variety of ways you can do it. Now, why would you do it one way instead of the other? I think that's the heart of this course. Okay? Why do you do it in one way instead of another? Why do you drink orange juice instead of eating oranges? Because you can't be bothered to cut it, right? Why do you take tablets? Because you can't be bothered to drink, right? It's fast, it's convenient, and you can take a whole lot of pills together, right? That would be kind of like the leverage solution, right? So the traditional or the clumsy way would be, that's like an orange over here. You know what I mean? Yeah. Finance is like that. You can think of it like that. All right, I think I'm gonna stop here, and I wish you a very nice weekend, and I wish you a very good week ahead. And oh, one more thing, just by way of housekeeping, two things actually. So before you leave, please remember to sign your attendance. Now the other thing is that, did Ryan talk to you last? Sorry, I wasn't there. I had an appointment. Did Ryan talk to you about there's a final assignment presentation project? Did he talk about that? He mentioned that. Okay. Now all the details are already on Blackboard, and I have split you guys up into teams. Did you know that? If you go to Blackboard, you'll find there is an assignment. This is the specification. I mean, we'll talk more about that, but it's due in 1 month's time. Seems like a long time away, actually it isn't. Okay. May 27 is a Sunday. So this is a topic. And it's quite clear, and we just need you to do a presentation. And just to be efficient, okay, I already split you guys up into 8 different teams. This is your last chance to mingle with people that maybe you haven't worked with before. Xin Bin is not doing this anymore. So I don't mean to wipe him out like that. He's been unwell, as you know. Okay, so have a look at that, and if you have any questions, just let us know. Okay. Any questions? I want to give a few people some points. 1, 2, 3. Why don't you come up here at the end? I'll give you the scan. Some three points. All right. So have a very nice weekend ahead, please.